Hey everyone, Joe Lentini here. The Big Beautiful Bill has some changes that affect possible car loan and mortgage interest deductions. No tax on car loan interest for tax years 2025 through 2028. Interest on new car loans for personal vehicles can be deducted from your taxable income even if you don't itemize your deductions. Loan qualifications. The loan must be a new loan incurred after December 31st, 2024, and secured by a first lien on the qualifying vehicle, meaning it is a brand new vehicle that no one else has used or owned. Refinanced loans can qualify, but only up to the amount of the original qualifying loan. Loans from related parties do not qualify. Dollar limit. The maximum amount of interest that can be deducted per taxpayer per year is $10,000. Income limitation. The deduction is reduced by $200 for each $1,000, or part thereof, by which the taxpayer's modified adjusted gross income, MAGI, exceeds $100,000 for single filers, $200,000 for joint filers. Income reporting requirement. To claim the deduction, the taxpayer must report the vehicle identification number on their tax return. Vehicle qualifications. Brand new cars, minivans, trucks, and motorcycles. The original use begins with the taxpayer, i.e. the buyer is the first user. Vehicle must be assembled in the United States. Fleet vehicles, commercial vehicles, leased vehicles, or salvage title vehicles do not qualify. Example. Katie buys a brand new SUV in May 2025 for her own personal use. The SUV was assembled in the US and Katie is the first owner. She takes out a $40,000 loan at 6% interest, secured by a first lien on the vehicle. In 2025, she pays $2,300 in interest on the loan. Her MAGI is $95,000. Katie can deduct the full $2,300 of interest paid on her 2025 tax return. Since the interest she paid is $2,300, which is less than $10,000, the annual cap. Mortgage interest deduction. The Act permanently extends the TCJA's provision limiting the Section 163 qualified residence interest deduction to the first $750,000 in home mortgage acquisition debt. It also makes permanent the exclusion of interest on home equity indebtedness from the definition of qualified residence interest. The Act also treats certain mortgage insurance premiums on acquisition indebtedness as qualified residence interest. As always, we're here to help you navigate these new rules and make the most of your tax situation. If you have questions or want to discuss your personal circumstances, please contact our office. We're committed to helping you thrive under the new tax law. If you'd like to schedule a tax planning phone appointment to discuss the impact on you and your family, our special summer rate of $75 for a 30-minute consultation, which is 50% off our regular rate if scheduled between now and September 15th. Then the rate through October increases to $125 for a 30-minute consultation, and finally the full-time rate of $150 will kick in after October. We're here to help you and would love to discuss how we can help you make the most of these new tax laws.